Let's welcome in now Scott Bauer, CEO of Prosper Trading Academy. Very good morning to you, Scott. Thanks for joining us. I mean, I'm sure you heard what Kevin and I had to say. I just want your sort of thoughts on the markets right now at all-time highs, no doubt driven by a number of headlines. One, of course, we had the China trade truce being kicked down the road, and as far as that can is concerned, and then the CPI, of course, which came in a bit mixed yesterday. So it seems that a combination of moderate inflation and a bit of tariff uncertainty that's been lifted has been keeping a cap on that volatility. And it seems like we've got two stories and one message that the markets are in wait-and-see mode right now.
Yeah, there's definitely one message here, but I would tell you, and I think Kevin would say the same thing, that the traders on the floor here look at things a little bit differently than what the market is actually doing. The market seems to be off to the races here. New highs, new highs, new highs, and too much complacency. But the traders down here, both in the S&P 500 pit and the VIX pit, they're definitely concerned. Just concerned because of that complacency and volatility too low. So I personally think volatility is too low. There's a lot on everyone's plate moving forward into the next quarter as we finish up earnings season here, as we talk about the Fed. Nonetheless, though, things are looking pretty good. Now, in terms of CPI, there was an interesting report yesterday from Goldman Sachs. They foresee year-over-year core CPI being up to 3.2% by the end of the year. And they also said that if it weren't for the tariff situation, that would be down at 2.5%. So, I think Goldman, a lot of other investment houses, economists are looking at this and saying, we better be careful towards the back end of the year because that's where we may start seeing some of this tariff effect.
Oh, absolutely. And particularly back to my original point. I mean, if you have a trading relationship like with China, if you're talking about, 145% tariffs, if they're not going to come into effect until the end of the year, you're probably not going to see that true material impact from some of those duties certainly showing up in the prices. At least that's what the street's view is. But then to your point, I mean, what do you make of, some of Scott Besant's suggestions of 50 basis points in September then?
Yeah, personally, I don't think 50 basis points is necessary. I don't think it is the right thing to do. I know they want to be super aggressive and kind of get on that train. And if you do look at the CME FedWatch tool, which Kevin was talking about also, CME FedWatch tool has now priced in basically 100% probability of a quarter point decrease in September, a 70% probability of another quarter point decrease in October. So unless we really start to see some weakening economic data, we'll get a new jobs number for August just in a couple weeks at the beginning of September. We'll get PCE coming up in a little bit. Unless those numbers are really weak, I can't see a scenario where there's a cut more than a quarter point. And you know what, Sam? I think we also have to keep in mind, we better be careful what we're wishing for. Because if that data does come in weaker than expected, and if that puts pressure on the Fed to cut more than a quarter point, maybe they're going to start thinking about cutting for the wrong reasons, meaning the economy is really slowing down. Maybe the consumer is starting to get hit a little bit. So I do think we need to express some caution. Maybe that's the trader in me, but I think we all need to be a little bit cautious here.
I've got to say, Scott, though, I mean, you're not the first person that we've heard that, particularly traders, saying that the VIX is screaming complacency right now. That certainly had been a word that had been creeping into the narrative, particularly in recent weeks. I'm just curious. Yesterday, we saw market breadth. We saw a number of sectors and the small caps also catching a bid. But I mean, I was looking at sort of a longer term chart with the Russell 2K. It really hasn't managed to break through that 2,300, 400 level. I'm just wondering what you're thinking about as we talk about some of this lack of breadth in the market.
Yeah, absolutely. And I think what we saw the big spike in the Russell yesterday because of that probability of a rate cut. We know that the small caps really benefit when rates come down here, but there's also a big catch-up trade there, meaning that the Russell has lagged the NASDAQ and the Dow and the S&P for quite a while here. So that's really one to keep a very, very close eye on. And like you said, it has had trouble breaking through those levels there. If they can't again, that to me is another sign that too much complacency. Maybe it's time with volatility so low just to buy some of that protection going out. Again, I've got my trader's cap on as I've been doing for, 35 years, so I may have a little bit different outlook than some other people here. But Sam, as Kevin would say, this mantra of buy when you can, not when you have to, meaning that when you have the opportunity to buy that protection, just like when you have to go out and get homeowners insurance, car insurance, whatever it might be, you do it when you don't need it, right? So that's the time to do it. And that's what I think that the traders on the floor are certainly looking at right now.
Right, and it's certainly fascinating as some of that sort of stickiness in the services inflation too, particularly when you look at some of those airfares. Just a quick thought on the earnings, particularly because, Kevin just highlighted two very different companies, but telling us a lot about the AI narrative and the consumer trends right now. What are your thoughts? I mean, what have been some of your big takeaways? As I mentioned, something that I've been noticing is a lot of talk of bifurcation in both the AI story and the consumer. What are your thoughts?
Oh, no doubt about it. And those companies that have not met or exceeded expectations or that have given, poor guidance or maybe mediocre guidance, they've been punished. But the other stocks that are out there that have really, met even if they're reduced expectations, those stocks have done really well. I think we absolutely have to focus on the AI theme. There's no question about it. But as we're seeing with CoreWeave here, if you're not up to snuff here, the market's going to punish it because there are other opportunities. There are other places in the same sector for people to go to. So it is definitely something to watch as we wind down earnings season here. Yes, the behemoth of them all, the video we've got shortly in a week or two. And then, we get a lull a little bit, but there's no question that AI specifically is going to be the theme to watch going into next quarter's earnings.
Yeah, I think this earnings season has proven that it's just not enough if you clear the bar. You certainly have to be offering a lot more as far as investors are concerned. Scott, it's been a pleasure talking to you. Thanks so much for getting us set up for this trading day. Scott Bauer, Prosper Trading Academy. Really appreciate your time.